Okay, so we're at the last section of the chapter. Like I said, it's going to be really easy to talk about, but more tedious to do. It just takes a look at, we've done all of our adjusting entries. Now we have to update trial balances and get our financial statements ready. So from a vocabulary standpoint, here's where you'd maybe want to check your notes to make sure it's updated there, or you can add it to the supplemental handouts that just came to you. What is an adjusted trial balance? Well, if you think about, we know what a trial balance is. That's what we did last chapter. Okay, that's where we journalize, post, take all of the general journal final balances and make an adjusted trial balance. But now we're going to do a second one after we've adjusted or done our journal entries for what we've used or what's happened. Okay, an adjusted trial balance truly is a second one, like part two, if you will. Okay, it's prepared after all of the adjusting entries are journalized and posted to the general journal, or general ledger, excuse me. The whole purpose of a second one is to prove the equality of the debits and credits, basically, after all the adjusting entries have been done. And its whole purpose is so you can prepare the most up-to-date financial statements that you can. I wanted to stop and just remind you of the process. Before, in last chapter, we journalized, posted to the general ledger and all the individual little accounts. From there, we brought stuff back to the journal saying what account they went in. And then also from here, we did a trial balance. The whole process is repeated with the adjusting entries. We do all of that same stuff again, so ditto with adjusting entries. The only thing we didn't do this chapter, we just did the journalizing. We didn't go post them, bring the account titles back to the journal entry, journalizing. And then, of course, we do another trial balance, but it's called the adjusted trial balance. Here's what it looks like. You have a handout that would have come to you. It looks very much like our original trial balance. There's a debit column and a credit column. Notice, though, the numbers illuminated in red. The numbers illuminated in red are changes from what? Why would supplies and prepaid insurance and equipment depict a change? They've been used or gone down in value. We've got some contra accounts down here, like supplies expense, insurance expense. So basically, you could find all of the partner accounts in here. Would you agree? One thing I would like all of you to do between owners, drawings, and revenue, draw a line across your trial balance. Above the line are all the balance sheet accounts. Below the line are all the income statement accounts. So each of those adjusting entries, you could find the partners if you needed to. Would you agree? Yeah. So now, basically, we take these numbers and we make three different financial statements. We make an income statement where we use net income to impact in here, and then we take that owner's equity number and that shows up in the balance sheet. So doing your financial statements in this order is important. What do the financial statements look like? Go to the next page in your notes. This looks really complicated, but basically it's just breaking everything down. Okay, here's that adjusted trial balance we just looked at. I'm not sure if the numbers are the same, but nonetheless, here they are. I love this sheet. It's in your book, but I wanted to give you a printed version so you could reference it and use it, and there it is. You basically make an income statement and an owner's equity statement, and you're pulling these final numbers and putting them in the correct spots. And then if I go on to the next one, same thing, a balance sheet. But just remember, this net income number shows up down here. And then remember this owner's capital, like it's talking about here, is a math-based number. Do you guys remember that from a couple chapters ago? Okay. So for the exercise that we're going to do together, you're going to be given one of these. And basically, we're going to make the 3 financial statements together. Should we try it? All right. That really concludes the lecture piece of the chapter. Let's fire up exercise 314. Like I said, we'll do this one if time permits. It's challenging, and you might say, why? What's so challenging? They're just adjusting entries. You have to really hunt for the numbers. So instead, we'll do the 3 financial statements. You are very dependent on looking in the book to get the numbers. Do you see smack dab in the middle of page 141? It's the Frenzy Company. There's really a trial balance before the adjustment and after the adjustment. Do you see those 2 columns? We're, of course, using all of the after the adjustment. Just so you see how this works, just take a look at supplies. What did we start with supplies for the year? 2,300. What did we end with? 900. So 2,300 minus 900 is what we used, and that would have been the adjusting entry. Okay. You can tell exactly how much we use, because if you look down under supplies expense, it started at 0. Is 2,300 minus 900 1,400? It is. And so then you can see the contra account down there. Okay. Like I said, if time permits, we'll do adjusting entries based off these 2, but you have to hunt for the numbers like we just did. Okay. So of these columns, we're looking at all of the accounts. So cash, AR, supplies, and then all of those after the adjustment adjusting entries is what we'll actually create in the income statement, owner's equity account, and balance sheet. All right, let's try this. Line 1, does it say revenue? It does? All right. So on line 1, notice we're actually titling it revenues because there's more than one. Okay, what order would you put them in? Probably the best would be to put them in the order that shows up on the trial balance. How many revenue accounts do we have? Remember, unearned rent revenue is a liability. Okay, so that's work that we owe to people. How many revenue accounts do you see? 2. So you can list them, service revenue and rent revenue. Do you have 2 columns, if I recall? I did this a while ago, so I don't exactly remember what your workbook shows. Good, good, good. So service revenue and rent revenue. Remember, we're pulling balances from the adjusted trial balance. I see a line. I see a line right there. Why? There's math above. Are we adding or subtracting that 11,900? We are going to add that for what's called total revenue. I guess in my world, I'd put that 47,900 right here in the right column. They show, my answer key shows the left column, but whatever. Are we going to double rule after that total? Because is there more math to come? Remember, an income statement takes a look at revenue minus expenses for either a net income or a net loss. Does it skip a couple lines and go to expenses for you? Do you have the title expenses listed there? Okay, good. Let's count. How many expenses do you see? 5. Now, why do some of them have balances in the before and some of them don't? When are 3 of them used? During the adjusting entries, okay? So you'll see salaries, you'll see supplies expense, insurance, and depreciation expense starting with 0, but we're going to end up using their final balances. Again, you can put that in the left column because we're doing math. And we, of course, would add all of those up. I'm going to star the 3 that started with 0 balances because those are the contra accounts that are used when we do adjusting entries. The other 2 are used for adjusting entries. They just happen to show up throughout with a balance prior. I'm going to see a single rule. We'll also list total expenses. Again, I'd like to see that number where they put it. My answer key gets a little bit funny. So just by looking, not even doing the math, did we have a net income or did we have a net loss? We did have a net income. So 47,900 minus 36,900 is a net income of $11,000. At that point, you'll see the double rule, simply because we're done with all of our math. And I know the double rules are kind of hard to show up on all of their deep lines that they put on their workbook pages. If you have a highlighter, grab it. If not, just circle it, like it looks like I'm going to have to do. That 11,000 is going to be used somewhere else, isn't it? We're going to highlight that 11,000, and we're going to actually use that in another spot. Which financial statement is next? The owner's equity statement. This is a little bit more consolidated than what we're normally used to. We normally take a look at what we start with and end with, plus net income, plus more investments, minus what? Drawing, okay? They didn't make additional investments. And look through that list. Do you see owners drawing anywhere? We would subtract that out though, okay? So what was the balance as of the first of the month? Well, where did we get that? If I look at owner's capital, started at 15,600, ended at 15,600. Now you might say, how do I know the date to be using? Well, we're dealing with a year. It's for the year ended on August 31st, 2014. So the year started on September 1st the year prior. Again, dates get a little bit messy. If you absolutely were confused on this, I'd be okay with owner's capital, comma, beginning. If you were confused with where the date came from, I feel like I explained it pretty good so you can see where the date came from, but we're looking for the beginning and the end. Okay, I don't see any extra investments, but what money does the owner get to add on to that? Net income. Add net income. Are there two columns again? Okay, okay. Add net income. There were no drawings, but that's where you would subtract off the drawings had there been some. So the owner's capital at the end of the fiscal year are those two combined. What I do want you to do is add a little star in here. Deduct owner's drawing if there had been some. Okay, I think it's important to remember that because it's been a couple chapters since we've done this, which in this case was not applicable. $26,600, are we using that somewhere else? Highlight that number. In my case, I'm going to circle it. And that is the math-based number that's going to show up on the balance sheet. $15,600 might look like what's going to show up there, but remember the owner gets to keep $11,000 of his or her capital. For the last financial statement, we're going to create a balance sheet. Unlike the owner's equity, unlike the income statement, a balance sheet's a snapshot in time. A balance sheet can change by the day because you might use a little bit of your supplies or you might gain more cash or anything else that impacts there. So you'll next see the balance sheet. Remember, ALLO, we are going to double rule after assets because assets equal the liabilities and the owner's equity together. I want you to count how many assets you have. This one's a little bit of a trick. This is a little trick question. There's actually 6. There's 5 true assets, but that accumulated depreciation is a contra asset account. It devalues equipment, but you still have it as a line item on there, okay? If I wrote the textbook, I wouldn't have included that here because that, or I would have taught the depreciation chapter first. So there's actually the 6. There's the 5 true assets minus that contra account. So let's get as far as prepaid insurance and then we'll deal with that equipment. So you can list those. Notice they're putting them in the far left column or far right column, excuse me. Because we've got some math involved here. You'll see that in a minute. So let's talk about equipment for a minute. It looks like it's valued at $14,000, but accumulated depreciation ended at $45,000. So to get our true value of equipment, we're going to list that, take that $14,000 and put it in the left column. But then we need to subtract off the accumulated depreciation. Because remember, this is a contra asset account. It contradicts or it devalues that asset. So our equipment really isn't listed at its $14,000 worth because time has gone by and we adjusted for what was used. So our equipment is actually valued at $9,500. So by the time we've accounted for that devaluation of that accumulated depreciation, you can take your 1, 2, 3, 4, 5 assets now and add them together. Because we've ended that allo piece, the assets equal, that's when you would want a double rule after that 34,100. Do you guys have liabilities listed as a heading? Yep, good. How many liabilities do we have? Remember, unearned rent revenue is 1. We have 3. We have an accounts payable, we have a salaries and wages payable, but remember, unearned rent revenue, we all work, don't we? Someone's prepaid. And so because of that, we're going to actually have the liability section look like this. List the 3, but then indent to say total liabilities. In the past, have we needed total liabilities if there's only one account? No. But because they're itemized and there's more than one, we do have to stop and subtotal that. Well, you would think, gosh, it makes sense to have them over in the left column, which you're welcome to do. You'll see my answer keys pop between how they structure it, which is a little bit annoying. I don't make the answer keys. I remember when I did this in my own workbook, I did put them in the left column. Why is unearned rent revenue a liability? It's got the word revenue in it. It seems like it should be in the revenue. It has the word unearned. Ira's correct. Someone's paid us, but we haven't earned that revenue yet. As soon as we do some of our work, unearned turns into earned, and then it will show up on the income statement. You'll list owner's equity as a heading. What account is going to show up under the owner's equity umbrella here? I heard someone say at capital. And where are we getting that number? From above. And here's where accounting is lovely because it all works out. It's either right or wrong. And that 3410 needs to match the assets. And it does.